83 billion euros. I want you to sit with that number for a second. Not because it's the biggest number in finance right now, but because of what happens when it starts to move. If a typical European family saves 10,000 euros a year, which, let's be honest, is already a lot, you would need 8 million of those families, saving every single euro for an entire year, just to reach that number. But here's the thing, that 83 billion is not sitting in a vault. It's not waiting. It has already been lent out, spread across hundreds of companies working inside businesses you've probably never heard of. It is active. It is moving. It is exposed. And last month, for the first time in over 3 years, it started losing money. This is Blackstone's flagship private credit fund, one of the largest pools of private lending on the planet. And on paper, a small monthly loss sounds like nothing. These things happen, except that's not how this product is sold. This is sold as steady income, predictable returns, 8% a year, better than your bank, and supposedly just as safe. So when a fund this size starts bleeding, even slowly, you have to ask the same question you'd ask if you walked into a zoo and saw the elephant sneeze. Is it sick? Can it spread? And is the rest of the zoo actually fine? That's what we're here to figure out today. Before we get into what's happening right now, I need to give you the foundation. Because private credit didn't appear from nowhere. It's the end of a very long road. For centuries, the financial system has been doing one thing, just one thing, over and over, in increasingly sophisticated ways. Moving trust from people to assets. A long time ago, lending was personal. It was about who you were, your family, your reputation, your word. Credit was human. Then the system evolved. Banks stopped asking who are you and started asking what do you own? Do you have property, cash flow, collateral? That shift was enormous. It meant credit could flow to strangers, across borders, at scale. And private credit is simply where that evolution ends up. Credit that has been stripped of every human element, reduced to contracts, models, and spreads. No relationship, no judgment, just math, which sounds efficient until the math is wrong. Now here's the second thing the financial system learned to do, and this one is stranger. It learned to sell the future. In a traditional loan, time is simple. You lend money for 5 years. You wait 5 years. You collect interest, slowly as it comes. Modern finance decided that was too slow, so it built a system that could take those 5 years of future payments, package them, slice them, price them, and turn them into cash today. Think about what that actually means. The income from the next decade and sold, right now, to investors across the globe. That's not magic. That's the entire business model. But here's the problem. Nobody talks about. When you compress 10 years of income into today, you also compress 10 years of risk. All the uncertainty, all the potential defaults, all the things that could go wrong between now and 2035, they don't disappear. They get hidden, delayed, and eventually released all at once. It's not a money printer. It's a pressure valve. And right now, it's starting to leak. Let me show you exactly how this plays out in practice. There's a term you need to know, PIK, payment in kind. In plain English, instead of paying interest in cash, you pay it with more debt. Here's the scenario. You're a fund manager. You've lent 100 million euros to a software company. They build customer service platforms. For years, it was the safest bet you had. Recurring revenue, predictable cash flows, no drama. Then one morning, you open the news. ChatGPT upgraded again. AI customer service now costs 1/10 of what your borrower charges. The phone rings. It's the CEO, and you can hear it before he even speaks. We lost 15% of our clients last month. Everyone is switching. We're thinking about selling. Now you have a choice. You could mark this loan down, record the loss, show your investors what's actually happening, or you offer the CEO a deal. Don't worry about the interest this year. We'll add it to the principal. Next year, instead of 100 million, you'll owe us 110. That's PIK. And on your books, everything looks perfect. The asset didn't shrink, it grew. The income didn't disappear. It was recorded as accrued interest. Default rate, 0. The garden looks beautiful, right up until the frost. Because what's actually happening is this. The company's debt is growing faster than its revenue. Last year, 100 million. This year, 110. Next year, maybe 130. Eventually, the profit doesn't cover the interest. The company becomes a zombie. And the fund is sitting on a loss it hasn't admitted to anyone, including itself. This isn't one company. This is a pattern across hundreds of loans, across an entire industry. Problems aren't being solved. They're being postponed. And the moment investors start to sense that, they want out. So what happens? When everyone wants to leave at the same time, here's the structural problem. The money is locked. It's inside 5-year loans. You can't pull it out because someone asked nicely. So a fund manager has 3 options: sell assets and accept whatever price the market gives you, which in a stressed market is never the price you want. Gate the fund, restrict withdrawals, which tells the market exactly what you don't want them to know, that there's a problem, or use your own money to buy time, which only works if you have enough of it. None of these are good options, and here's what makes it worse. Markets don't react to facts. They react to signals. The moment you gate a fund, you send a signal, and signals travel faster than spreadsheets. Now, I need to be precise here, because this part gets muddled in most coverage. Blue Owl made 2 very different moves in the past few months, and they're not the same thing. In January, their OTIC fund actually raised the redemption limit to 17.5%. That was deliberate, a pressure valve. Let the nervous investors out before the panic builds. Then in February, a different fund, OBDC2, did the opposite. They permanently halted redemptions, locked the door. At the same time, they sold $1.4 billion worth of loans from 128 companies at close to face value. Now, selling at face value sounds like good news, and it is. It means the market hasn't seized up yet, but look at the stock price. Over the past year, Blue Owl has lost nearly 2/3 of its value, not in a week, over a year, and right now it's sitting near its all-time low. That's not panic. That's a slow, steady reassessment. The market has been saying something, quietly, for months that the headlines are only now starting to catch up to, and the question everyone is now asking out loud is, who's next? If this feels familiar, it should. The structure is not new, only the asset has changed. 2008, the underlying asset was American mortgages, packaged, rated, sold as safe, until the defaults came and the chain reaction started. 2022, British pension funds. They used leverage to chase returns. When rates spiked, they needed cash urgently. They had to sell at the worst possible moment. The Bank of England had to step in within days. 2023, Silicon Valley Bank. Short-term deposits, long-term bonds. When depositors wanted their money, the bank had to sell assets at a loss. It was over in 48 hours. Every single time, with the same structure. Short-term money, long-term bets. When the two sides stop matching, everything happens very fast. Today, the asset is software loans. The trigger is an AI revolution that nobody priced in. But the logic is identical. There's a saying on Wall Street: when you see one cockroach in the kitchen, there are never just one. One has already walked into the light. Let me give you a map, not a prediction. A map of where we are inside a pattern that has a shape. Phase 1, the fuse, late last year into January. AI started disrupting software companies. The underlying loans began to crack, quietly, invisibly. The signals were there if you knew where to look. Software valuations being marked down, layoffs starting at companies that were supposed to be safe bets. Phase 2, the visible fire, February and March. Where we are now. Blue Owl Gates redemptions. Blackstone reports its first loss in 3 years. Apollo's leadership calls out the entire industry's valuations. The headlines arrive. The redemption requests come in like a tide. What changed between Phase 1 and Phase 2? Not the underlying reality that was already broken. What changed was that people started talking about it. Phase 3. Liquidity dries up. The next few months, possible, not certain. More funds face redemption pressure. Asset sales stop being isolated events and start becoming a pattern. The question stops being, is Blue Owl okay? And becomes, who else is doing this quietly? If Blackstone needs to use its own capital to support its fund, that's when the alarm gets louder. Phase 4, the transmission. Possibly from the second half of this year into next. European pension funds start disclosing losses. Banks tighten lending. The real economy starts to feel it. Not as a financial story, but as a credit story. The signal to watch, a European regulator issuing a formal private credit risk warning, or a mid-sized European bank with unexpected exposure. We are in Phase 2, which means this is not the time to panic. It is the time to act. To understand where this goes, you need to watch people, not numbers. 4 people, 4 very different positions. John Zito, Apollo, co-president of Apollo's asset management division. A few weeks ago, he said something remarkable in a room full of clients, not the press. He said, every current private credit valuation is wrong. An industry insider attacking his own industry? Why? Because Apollo has almost no exposure to the software loans that are bleeding. He told analysts directly, software is less than 2% of their portfolio. Private equity exposure to software? 0. So when he says the valuations are wrong, he's not describing his problem. He's describing everyone else's problem. He's already stepped to the side, and he's watching. His estimate for recovery rates on some of these loans, 20 to 40 cents on the dollar. That's not a warning. That's a positioning statement. Steve Schwartzman, Blackstone, the architect of modern private equity, 40 years in markets, seen every crisis from the inside. His fund just posted its first loss in 3 years. He is not talking about it. That silence is data. When Schwartzman speaks, markets listen. When he doesn't, you listen harder. He's either waiting for the floor to become clear, or he's deciding whether to use Blackstone's own capital to backstop the fund. Either way, he doesn't know what the bottom looks like yet. And if he doesn't know, nobody does. Mark Lipschultz, Blue Owl, a veteran of private credit who knows exactly how fast liquidity disappears. His move in February, selling $1.4 billion in loans at near par, wasn't crisis management. It was a calculation. He sold today because he believes today's price is the best price he's going to see for a while. When someone with his experience sells at face value, he's not saying the assets are worthless. He's saying, wait 3 months and face value might be a memory. Christine Lagarde, the ECB. Here's what analysts are watching closely. European pension funds, Dutch, German, Nordic, they didn't keep their money in European bonds when European bonds paid zero. They went looking for yield. They found it in American private credit, which means if this market cracks, the ECB faces a question it does not want to face. Do you let European pensioners absorb the losses, or do you intervene and explain to taxpayers why? Neither answer is clean. Watch her speeches. If she starts using the words shadow banking or private credit, it means the conversation has officially reached the top floor. Now, you might be sitting somewhere in Europe thinking, this is an American problem. Let me show you why it isn't. I'll give you 3 countries, 3 completely different vulnerabilities, all pointing in the same direction. The Netherlands. The Dutch pension system is the largest in Europe relative to GDP. Right now, 9.5 million accounts are in the middle of the biggest structural reform the system has ever attempted, switching from defined benefit to defined contribution, with a deadline of January 2027. In plain English, the guarantee that used to say, you will receive this amount when you retire, is being replaced with, you will receive whatever the market gives you. ABP, the largest pension fund in the Netherlands, 500 billion euros under management, is executing this transition in 2027. ING has estimated that this process alone could trigger large-scale selling in long-duration bonds as the portfolio is rebalanced. The Dutch pension system is having the most complex surgery it has ever had, in one of the most uncertain market environments in years. The timing is not ideal. That's the polite version. Sweden. When people talk about European real estate risk, they point south. Italy, Spain, Greece. The IMF pointed north. In its formal assessment, published on record, the IMF found that under stress scenarios, 3 in 4 Swedish commercial real estate companies cannot cover their interest payments. Not might struggle. Cannot cover. Swedish property companies rely heavily on bond markets for financing, not bank loans, which means when global credit tightens, the refinancing cost hits them directly and immediately. This isn't a distant theoretical risk. Sweden's largest banks, Swedbank, SEB, have enormous exposure to this sector. Regulators already know this. They've required additional capital buffers specifically for commercial real estate. The most dangerous real estate market in Europe is not where you think it is, the United Kingdom. London is one of the global centers of private credit. If any institutional investors understand this market deeply, it's the British ones. So pay attention to what they're doing. According to the most recent Nuveen Global Institutional Survey published this month, nearly half of UK institutional investors made their largest reduction to US market exposure in the past 12 months. 38% expect US capital market dominance to decline over the next decade. The people who know the system best are adjusting their position. At the same time, the UK government's Mansion House Accord, signed by 17 major pension providers, commits to putting 10% of assets into private markets by 2030, half of that into UK domestic assets. Read that carefully. The institutions are reducing US private credit exposure. The government is pushing pension funds toward more private market exposure. These two things are happening simultaneously. That tension is worth watching. The Cayman Islands feel far away. Wall Street feels far away, but some of this is much closer. I live in Hungary, so let me show you what this looks like when you zoom in to where I actually am. Layer 1. Sovereign credit. Hungary's public debt sits right at the edge of investment grade. If S&P downgrades by one notch, many international institutional investors are legally required by their own mandates to sell. Private credit stress is one symptom of a bigger shift. Global capital is repricing risk, and when that happens, money moves away from the edges of investment grade. Hungary sits at those edges, and the forint has been weakening, not because of anything Hungary specifically did, but because global investors are pulling capital from emerging markets and moving it toward dollar assets. Forced selling drives bond prices down. Borrowing costs for the government go up. The forint comes under pressure. This risk is growing. Fitch's latest report flags Hungary's 2026 deficit at around 5%, but pre-election spending is already running ahead of that. Military bonuses, family tax breaks, a 14th-month pension payment. Add to that, roughly 30% of Hungary's public debt is denominated in foreign currency. If the forint weakens, the cost of servicing that debt rises automatically. That's what global liquidity tightening looks like when you're standing inside it. Layer 2. Pensions. In 2011, the Hungarian government moved the assets from the mandatory private second pillar pension system back into the state system. According to ILO data, that was roughly 10% of Hungary's GDP transferred in a single policy decision. I'm not saying that happens again. I'm saying it happened once. In Central Europe, pension architecture is not fixed. It moves with fiscal pressure and political priorities. More recently, there have been reports of discussions about new labor market entrants being required to choose private pensions from September 2026 onward. The system is still evolving. That's worth knowing before you assume that the rules you see today are the rules you'll retire under. Layer 3. Tech startups. Budapest has been called the Silicon Valley of the Danube. Warsaw and Prague have real startup ecosystems. Some of the financing that keeps those companies running traces back, directly or indirectly, and US and Western European private funds. If those funds tighten their investment strategies, the effects show up here. Delayed funding rounds, valuation adjustments, tighter loan conditions. It doesn't arrive as a headline. It arrives as an email from your CFO saying the next round is taking longer than expected. Sovereign ratings, pension policy, startup funding. These aren't abstract risks. They're things you feel when you open your banking app, log into your pension account, or read your company's internal updates. The distance between Wall Street and Budapest is shorter than it looks. Let me leave you with one image. You're standing on a beach, and the water starts pulling back. Further than usual, much further than you've seen before. Some people notice, most don't. They're looking at the shells on the sand. Financial systems work this way. When liquidity is everywhere, risk feels invisible. When it starts to drain, the structure underneath gets exposed. We don't know how far the water goes back. We don't know when it returns. But the people who noticed early always had more choices than the ones who didn't. That's the only edge I can give you. I'll see you in the next one.